Joining us now, portfolio manager at JPMorgan Asset Management, Phil Camporeale. Phil, great to have you on.
Morning.
I'm going to start right there with that question. How do investors navigate this?
Yeah, so I think what we got from Friday, Morgan, was a little sigh of relief for both stock and bond investors. And as you know, I'm a multi-asset investor. So the relationship between stocks and bonds mean a lot to us. And in August, this kind of 3% pullback in the market was not because of growth concerns. It's kind of like a high-class problem. Growth is fine, but is it too good? And I think on Friday, what we got from Chair Powell was at least a nod to the fact that they have to be really careful when they're so restrictive. So, too much tightening would risk growth. But Morgan, on a scale of, a hawked up scale, 10 being most hawkish, they're still at about a 7 because, the base case should be that they're going to be on hold. But the risk is that a combination of either very strong housing or employment data just rekindles an inflation concern that they want to get in front of.
All right. So you mentioned your multi-strategy.
Yeah.
How compelling is the bond market right now, especially with the 10-year back at, 15-year longer highs?
Yeah. So what we need to see, Morgan, is a stabilization in rates. We're overweight interest rate sensitivity, which means we're overweight duration in portfolios. But we have a no recession view. Our recession probability is only 20%. So if there's like 3 scenarios, hard landing, no landing, soft landing, we're firmly in the middle at the soft landing camp, which, Morgan, for us, means that things like high quality, high yield, where I can get 8%, which, by the way, is the long-term capital market assumption for equities, in the near term make a lot of sense. My biggest competitor is still the 3-month T-bill that everybody thinks is this great story. And cash for us is okay, but we would rather get more yield in credit than in cash. But I wouldn't be underweight equity here. Again, if I think that we're not going to be in recession and we think that the Fed is just about done with their tightening cycle, this broadening out story that Bob talked about, I think makes a lot of sense as well. That kind of keeps equities marching higher.
So when do you think equity FOMO really begins? Is it sort of a year-end dynamic, or you got to wait till?
Yeah, so Carl, I think we get some really big pieces of information this week on core PCE, which is the Fed's favorite inflation measure, and then payrolls. So, the payroll number this Friday, I think, just to throw a number out there, 200,000 is probably the line. Below 200,000, like last month when we got in the high 170s, that's okay. But above 200, the chair just said it, right? That will keep the super core measure of inflation pretty sticky. And I think that kind of keeps these interest rate environments alive. If they go one more, they're at 575, right? So 2 more gets you to 6%. These are really high federal funds rate levels that not a lot of people pressed in. But I can't stress it enough. This is a high-class problem, different from last year. Jackson Hole last year, they were talking about imposing pain on the economy because they were in the middle of their 75 base point rate hikes. Now it's different. Now we have a growth story, but they're towards the end of their cycle, Carl. And I think that should be a really good thing for multi-asset investors.
So to go from economic growth to growth in the equity market, the fact that Nvidia has been under pressure despite blowout earnings last week, I mean, it speaks to this dynamic we've seen in recent weeks in the market in general, which is basically fade the rally instead of buy the dips. When does that change, if that changes? Yeah, so Morgan, I think that's a pretty unique story with Nvidia because of just how much of a public story that was and how much people really wanted to get ahead of that earnings story. Listen, we think that the AI story is real. It's being adopted by large companies. We think that's really good for productivity at a time when inflation is moving lower and productivity moves higher is good. But Morgan, if this is a rally that's based again on the fact that the U.S. economy can grow at about trend, and the Federal Reserve can pause, not ease. I don't want them to ease. If they're easing, we're in recession. That's not good for equities. But if we're in this soft landing environment where the Fed can pause and just keep rates at these levels, that's going to be, lower VIX, lower rate volatility, good for the equity market, Morgan. But right now, while we're still waiting for the data, I would just rather pick up the yield in the portfolio than the equity risk. And that's the story.